The iThought team is coming together with 3 interesting webinars for you on July 13th, Saturday. We hope you'll be able to make it to the one that interests you the most. The first webinar is going to be conducted by the Sphere team at 10 a.m. and the topic is good investing in bad times, so you can take away what good investing looks like in different market environments. The second webinar is going to be conducted by the M2W team and will take place in Tamil at 11 a.m. The topic is Journey to 1 crore and we will be talking to investors about how they can go from where they are to 1 crore. The third webinar is a True Blue webinar where Yash is going to be talking about the dedicated freight corridor and how that is going to be a game changer for railways. This webinar will take place at 12 p.m. You can find the registration links to all the webinars in the description below.
Investing with the Sensex at 80,000. A friend asked me, Sensex is at 80,000. Should we invest now? I've been asked this question when the Sensex was at 10,000, 20,000, 30,000, 40,000, 50,000, 60,000, 70,000 and now at 80,000. Somehow, whenever a milestone is reached, we ask ourselves the question, is it a time to invest? But we know fully well that these milestones have been reached only to be left behind. We are going forward. The question is whether from here we go forward straight away or we recede a little bit, go back a little bit and then again go forward. There are no easy answers for that, but there is one definitive answer, that is the Sensex will always rise even if it falls. The question is never if, it's only when. As an investor, I have never allowed these milestones to affect my confidence or my belief in equity as an asset class. A lot of people think that they are investing at 80,000 into the Sensex. That is wrong. Unless you are an index investor, you are not investing directly into that valuation. You always have the option of investing in a part of the market which is undervalued. In every market context, there will be some part of the market which is undervalued. So you can always go and invest in that part of the market which is undervalued. You could become a contrarian and seek value, and if you are able to judge correctly, the stock which you buy as a value stock can become a growth stock in the subsequent years, even if the market recedes, let's say from 80,000 to 70,000. So the index can go down and the stocks you buy can always go up. That has been our pursuit at every milestone, whether it is 10,000 or 20,000 or 30,000 or any other round number. So 80,000 is just another round number to me, but there is a lot that you need to do around this round number. Let's ask Subra what he thinks of this round number and what we need to do at 80,000.
Shyam, people asked you at 10,000. When I entered the market, there was no index. Right? The index was created in 84 with effect from 79. I'm in the market since 79. There was no index. So what am I supposed to do? So many people who come in at 6,000 say, oh, I came in at 6,000, now the market is 12,000, what to do? Really nothing. You don't have to do anything. And like you said, even if you take our historic highs or the historic so-called booms, 2003 to 2007, pharma and FMCG did not participate.
Correct.
You can call it a boom. Index went up. Infrastructure, banks, all those cement companies, some of power companies just went through the roof, and it looks like the index went up 7 times, which it did, 3,000 to 21,000. Was it possible that you were invested throughout that boom and just did not participate because you had FMCG and pharma, which was 60% of your portfolio? Yes, you did not participate. So looking at the index makes no sense for 99% of the investors who invest in individual stocks. If you have bought a Suzlon, a Vodafone and a Yes Bank, it has nothing to do with the index, right? It is about sentiment. But if I tell you 14,912 marriages were conducted in Chennai yesterday, What does it mean? Does it mean tomorrow there can't be 15,000 marriages or can't there be 7,000 marriages? It's just a number. Don't get carried away by this number, because any time is a good time to buy undervalued stocks and any time is a great time to sell overvalued stocks. So you need to keep shuffling your portfolio or looking at your portfolio and saying this looks overvalued, but I'll wait for some time. Or something looks undervalued, but I think it might go a little lower and then I will buy. So thinking about the market you can do every time. Acting on the market should have nothing to do with the index.
My next question has to do with overvalued stocks. We have seen many times that overvalued stock can become extremely overvalued, and that extreme can be pushed to further extremes. That is something not in our control. Today, it is widely acknowledged that the markets are overvalued. In many parts, the market could be extremely overvalued also. But the extremes could be further tested given the kind of sentiment and liquidity you are having. Where you have that prospect before you, should the investor say, I made enough, markets are overvalued, and go back to safety and miss out on the last 10 or 20% or whatever remains in this rally? Or should he just ride it along, let it go where it goes, and when he feels it's too good to be true, just sell and go away? Which is a better option before the investor today?
Very difficult to say what will work. Let's say you got 15,000 shares of a company whose PE is 120 and historic PE has been 80 or 90. It's always been a high PE stock, but now it is at 120. Maybe the new normal, the company is going to be at 120. It is worthwhile for you, out of 15,000 shares, at least sell off 1,000 shares and put it somewhere else. Some safety, some liquid fund, it could be anything. I mean, whatever else you want to do with that money. And after some time, when the PE corrects and therefore the price corrects, buy it. But if the PE does not correct, but the EPS more than catches up, just kill your ego and buy it again. It's okay. You sold that share at say 6,500. Now you are buying it back at 6,600. It's still okay, especially if it goes to 8,000 or 9,000. Don't worry about the 100 rupees that you have lost. You just ride it again. So that is perfectly alright. But none of these decisions would be based on the index. It would be based on each individual stock. The indexes, people get euphoric. You look at television anchors, they're all young, they're still investing. Should they be happy when the index hits a new high, or should they be sad? They should be sad because you are a buyer. You're not a seller. So if you're a buyer, should you be happy when the prices go up? What happens is all the money that you have invested looks better now and you look smarter, and that is what you're celebrating. You should be actually mourning the fact that maybe next 20-30 years that you're buying, you're going to buy at higher prices. But again, these decisions comes to individual stocks or individual funds, not necessarily to the index. Index going up and going down is good for the media to hit headlines and say market crosses 80,000, what next? Actually, if you go to ChatGPT and calculate the TRI of the Sensex, I think it should be at 1,20,000 or 1,30,000, because we are ignoring the dividends in the index at 80,000. If you take the dividends, maybe we are at 1,20,000, 1,30,000. See what returns you are getting. If you are getting good returns, be happy. The total overall index doesn't matter. What really matters is your total portfolio return, where it will matter about how much you have in equity, which good quality equity, and that fact that you have not lost any money in debt. All this put together will give you a good portfolio return. You look at that. Looking at the index makes no sense. It's good fun when it lasts. You're watching people, if instead of 80,000, if you had hit 1 lakh, they would have made a fool's cap, put it on your head and said, we are celebrating 1 lakh. This will happen. Whether it will happen in our lifetime is something different, but it is very likely to happen soon, right? So don't look at the index at all. If you want to look at the index, look at it only if you are investing in the index fund. Otherwise, it is just noise. If you pick 3 stocks which are not there in the index, for you the index doesn't matter.
That's a very interesting point, and I entirely agree with you, because many times I have invested only looking at the stocks. My focus has been on the stock. Many days At the end of the market, if somebody asks me where did the market close, I won't know. But the 3-4 stocks that I am actively tracking for investment purpose, I will know what happened that day, what is the trading volume, how much delivered, how has the volume moved, how has the price moved, all those things I will know. But if you ask me how was the index volume today, whether the index futures volumes went up, whether more people are long than the previous day, whether the FIs are long or short, I wouldn't know all these things because as an investor, some of the things are not so material to me because I am looking at bottom up investing in, let's say, a small cap or mid cap space. Then I don't need to really be clued in on index related information. Having said that, most people spend a lot of time on index related information because they take the index as a validation of sentiment and they are looking for that validation to deploy more capital and to make changes in their portfolio. So they want to look at the index and decide what to do. But logically it doesn't make sense. As you rightly said, if I'm going to do my changes in defense stocks, which have moved up hugely in the last 1 year, you can't look at the index and then make the decision. You have to look at the companies, their valuation, their future prospect, whether everything has already been captured in, whether the companies reflect more than what their future prospect can deliver in stock valuations. All these things play a major part. And I would think that investors must be very, very bottom up in decision making in stocks, especially with respect to specific investment decisions of how much to buy, how to buy, when to buy and all that. And they should follow a top-down approach from the index downward on gauging the market mode.
Correct.
Because you need to know the market mode in order to pace your investment. Suppose market mode is very fragile. If you buy slowly, you'll probably get more shares for your money.
Correct.
You'll pay less for each share. And that in turn would, positively help your returns in the future. So in that sense, one should be more measured in buying at this time in the market, and one should also stagger his selling so that if there is a last leg to this rally, you should not be a mere spectator. These are some of the thoughts that I felt are relevant.
Also see what has taken the index up. Is we should now start tracking the TRI because you are getting the appreciation plus the dividend. A share which you have held for say 20-30 years, you are only looking at the appreciation in the share. You are forgetting how much of dividends you have got. What you did with the dividend is up to you. But if you had done a drip, which means you would have had more number of shares.
Correct.
So your overall return would actually be higher. But since we are not doing it and since we are not tracking it, we don't know the return. And the return on that particular share is far more important than what is happening to the Sensex.
Correct. So, your view is that look at the stocks, look closely at the stocks, look hard at the stocks, make your judgments at the stock level. And my addendum to that is use the Sensex as a sentiment marker. Don't make the Sensex as your sole decision variable because sometimes you may miss the picture completely at the stock level because you are too obsessed at the Sensex level. So, a right balance between the two things will moderate investors' behavior and it will always keep him grounded while still being hungry to succeed in equity investing. Thank you, Subra, for this interesting conversation on Sensex at 80,000 and investing in the market at 80,000.
Thank you.